Good to see all of you here again on Tuesday for this edition's Market Talk. My name is Ryan. I'm the market strategist at IG. And later on, you'll be hearing from my colleague, Nabil Mata, Premium Client Manager. So for those of you who are with us for the first time, this is where I go through the key events, the macro data, what's happening this week, a snapshot of the fundamentals, what might swing the markets based on fundamentals, and then later on we'll have a look at the technicals and the price action for this week and ahead of the rest of the month. So what's happening this month or this week? Let's take a look. But before that, we'll go through this disclaimer. All this information today is for educational purposes, no specific recommendations, and this does not take into account your specific financial background. All right, great. So let's recap actually what happened last week before going into this week to see how things have changed. So last week we were talking about China's stimulus measures with that policy with that interest rate moves. So they were trying to facilitate easier lending, and then you get the commodities bounce after that China stimulus move, which saw some of the iron ore prices bounce a bit and then fade. Of course, this week you're seeing commodity prices dropping off again, and we saw the euro dollar bouncing as well, and some sentiment from the Germany economy improving. And of course, we had the OPEC decision from Vienna on the Thanksgiving Day. They didn't do anything. As expected, oil prices dropped quite drastically, and we should be seeing them push to new floors. And for those of you who are following Black Friday, maybe some of you picked up some bargains. Things didn't pan out as well as everyone's hoping for. Black Friday sales were lower than last year by about 11.3%. So you can see not everyone's in the spending mood as much as before. So it's a sign that just keeping their money for a rainy day still. So ahead of Black Friday, we saw some of the e-commerce stocks picking up. And on this news and some profit taking, tech and internet stocks are under pressure. So last night we saw Facebook, Apple, a lot of these e-commerce stocks, Alibaba, Amazon, seeing a bit of pressure. So this should continue maybe for the next few days. And if you're, I guess, bullish on e-commerce stocks, this might be an opportunity to consider some of them on the dips. And overall, US markets were down as well on those numbers. But one thing to note is that these sales numbers are not going to be 100% accurate. It's just an estimate. So overall sales numbers may still come out better than this flash indicators. So this is something you should just take a pinch of salt at this point. And also this week, volatility is returning. Overnight trade, we saw prices of silver, gold, Brent, crude, and copper fluctuating quite a bit. So you can see quite a lot of action coming back to the market. So if you're a trend, or at least a short-term trend follower, you can get quite a bit of action just from last night. So this bounce as well is due to some oversold technicals. It's hitting some key levels, and you're seeing some technical reactions. One of the things that I'm looking at is the Volatility Index. I've talked about this before. So you can see right at the end, at the extreme right, you can see the green bars picking up again. So this is a sign of more people buying puts and calls options on the Chicago board, on the S&P 500. So it's just an indicator of how much fear and volatility is reflected in the overall market. So if you look at it, we're at about 15 points on the index now. It's come off a bit from, I'm going to pull out to a wider chart. You can see right here, where the cursor is, we were about 26. So that was when we had the Ebola fears and a lot of almost a perfect storm of data like weak Germany economy, China's slowdown. So all that came together during that week, which helped spike up from around pretty much where we are now, 14 to 25. So that's about close to an 70 to 80% spike. So are we going to be heading to those same levels? If you take a step back and look at the overall volatility index, we are actually at relatively low levels now. If you are expecting volatility to return in a big way with all the things happening in the oil markets, commodity markets, and any other reasons you can think of, then this is something you might want to watch closely for any possible spikes. Maybe geopolitical tensions might return from the likes of the Middle East or Ukraine. Anything might just trigger another flashpoint. This week as well, actually just this morning or yesterday, Moody's downgraded Japan's investment credit rating from A1 to AA3. It's just one notch. Outlook is still stable. Overall, Japanese economy from this rating indicates it's still strong and stable, but they just downgraded it to reflect some of the uncertainty from its the government's direction with its policies. So they listed 3 points. Fiscal deficit reduction goals. There's a bit of higher risk whether they can actually reduce their debt. Then you have the uncertainty over the growth measures. Pretty much Abe's 3 arrows, or the third arrow, is it going to be as effective as they hope it to be? So still not sure, especially with elections coming up. You don't know which government is going to be in place. And then you have also the last point, increasing risk of these Japanese government bond yields rising. So Central Bank of Japan is going to be buying, or rather the Japanese pension fund is going to be buying more bonds. So that is something they need to pay back eventually. So if the yields rise, that's going to be a harder hit on the overall financial position for the government. And on that news, we saw the Nikkei down this morning. Stocks not taking very well, and the Japanese yen picking up. What to watch out for will be 14 of December when we are expecting the snap elections. This is where pretty much Japan is going to decide, are they going to push through with what Abe has been proposing all along? Are they going to give him the mandate to push through with Abenomics? So Abenomics is going to be a lot of devaluation of the yen, and that is going to be helping support exporters, automakers, and pretty much push up Japanese equities. So if all goes to plan, Abe is expected to win. We should see some election euphoria and that to pan out, which will mean Nikkei to push up a bit and the yen to depreciate a bit more. So election euphoria always happens, not just Japan. A lot of we saw it in India as well when Modi took the helm, as well as Indonesia when Jokowi took office. Of course, what to watch out for is when the euphoria fades, which is when everyone takes profit. So for the question now, normally how does the market behavior before and after elections in Japan? Any historical data? Based on some estimates, or rather based on some historical studies, typically we see the Nikkei running up a bit. There's some studies which quote about 11% of a run-up. Of course, these are all historical patterns, and it won't always materialize it's not a sure bet. So this is before the elections. I suspect the nature of this Japanese situation to be a bit different because people are voting for a policy mandate. So there's some clear direction on what's going to happen if this government comes in. So there's going to be a bit of result not priced in yet, I suspect. So there should be still some upside after the voting goes through. Still be uncertainty whether Abe will win, but I think most bets are that he will win. So there's going to be a slight pickup, I'm expecting, ahead of the elections, and then maybe a bit of a jump when he officially gets the vote. So that's the picture now with this rather mixed outlook at the moment. It's not a sure win for Abe yet. Whereas if you look back at Jokowi, he was pretty much a shoo-in, or at least in the earlier stages, and you saw that pick up quite a significant amount very fast in his early stages of the voting. Okay, this week, these are it's quite a busy week actually to wrap up. You've got oil again. How low can it go? A lot of estimates are expecting a floor of $60. Of course, OPEC wants it to go as low as it can possibly afford to crowd out those US shale oil producers. So that was the rationale for not doing anything. They want to make it too unaffordable for the US producers and for them to close up and shut up shop. Some estimates are calling for $40. That's going to be quite a stretch at this point. I think it's not impossible, but it's going to be quite difficult to see $40 right now. Okay, there was also the Save Our Swiss Gold campaign or the referendum over the weekend. There was a vote where Switzerland had to pretty much decide, does it want to raise its reserves, its gold reserves, from about 7% to almost double. So they voted no. So of course, if they voted yes, they will have to buy gold, which will support prices. So no, market took it as a negative catalyst and pushed down gold prices. But that was Monday. Today we're seeing a bit of a bounce back on gold on some technicals. China manufacturing hasn't been very convincing. Yesterday's PMI numbers were quite soft. I'll go into that in detail in the next slide. Volatility returning, Black Friday sales, and Japan downgrade. So this week quite busy, and you have end of the week always. End of the first week of every month, non-farm payrolls to look out for. So let's check out what's happening on oil prices. We are currently around on Brent crude 72. You can see quite a little bit of support around this level. So that's going to take a while, I guess, fluctuate within this range until another negative catalyst comes along to push it down significantly. So if you pull back to a weekly chart now, you're looking at it, you can see the downward bias is still there. Although on the short term, if you look at the daily chart, there's a bit of a bullish candle, which might indicate a slight bounce in the very near term interim. Overall, downward bias is still there. So this is something interesting to look at later. Okay, Monday, I mentioned the China data came in quite soft. HSBC, China Manufacturing PMI, that measures the smaller companies, came in at 6-month low, 50, which is pretty much at the borderline of expansion and contraction. Official PMI was 8-month low, 50.3. So that's the measurement of some of the larger companies. So you can see manufacturing is not yet turning around yet, not seeing any signs or convincing signs that the Chinese economy is coming back online. So no demand catalyst for oil as well, or commodities like steel, iron, or anything that pretty much is exported to China. So until this turns around, we probably won't see any support for the likes of commodities and mining stocks. So all these will still be under pressure until we see some positive indicators in the global economy, which will need to come from China, also down here, Europe, especially Germany. Yesterday, some PMI numbers were also quite soft from Europe. They were under 50 for Germany. That's quite a bit of a negative thing, because we've been a lot of people are hoping for Germany to turn around or show more convincing signs and lead the European economy out of this sluggish phase. UK also still relatively okay, but it was a bit of it's lower than the previous reading. US readings as well was lower, so that didn't help the markets last night as well. Today we have the RBA's rate decision at 11:30 a.m. That's going to be Aussie dollar mover. As usual, they will typically talk about how the Aussie dollar is too strong, the currency is too strong and hurting its growth prospects. They've been talking about that for many months. We expect the same rhetoric again, and those commodity prices going down is not helping the Aussie dollar. So that's going to be the likely posture they're going to take. Not going to be a significant mover with a lot of attention elsewhere. Tomorrow we have Australia's GDP numbers for Q3. And one to watch will be China's services PMI in the morning. Another signpost of where we're expecting China's economy to hit into. So that reading, we're expecting it to come in at 52.5, slightly lower than the October reading of 52.9. So hopefully we see some better numbers to turn the economy around. Otherwise, we can expect mining stocks, copper, China A50, pretty much all those China-related plays to continue drifting lower. Thursday morning, we have some indicators on the U.S. economy with the Federal Reserve's Beige Book. They'll give a gauge of pretty much the U.S. economy is the strongest, most convincing story right now. So hopefully we see more traction on that front. We have a Bank of England talking about its decision again. We are not expecting any changes, no changes to rates. So we'll be watching out for its statement to see whether it's going to give any clues for future rate hikes. Not expected to be a surprise. The ECB, European Central Bank, will be giving its rate decision as well, and a bit of a press conference. So a bit of commentary to watch out for. There's been a lot of talk about how they might do more QE. So we expect the reporters to get some color on that. So that could be a euro-dollar swing, some volatility around this event. Later at night, initial jobs claims. So far, there's been a bit of traction. Jobs has been relatively robust. It's been above the 200K level for quite a while. So as long as it keeps stabilized around there, that should be positive for US indices and the dollar crosses. In the Friday evening, we'll get Eurozone's GDP flash. So another euro-dollar play and euro-pound cross to watch out for. And the one to watch this week, the data point everyone's looking at, is the non-farm payrolls and the unemployment rate from the US. We're expecting it to come in at 222,000 for non-farm payrolls. That's going to be an improvement from 209,000 last month. So hopefully this is going to be positive for markets after one entire week of soft macro data. Maybe this would be the one to help turn around sentiment at the end of the week.